Now, if we can just introduce Iain. Iain is head of the UK equity team at Baillie Gifford, and he's also the manager of Baillie Gifford UK Growth, who he co-manages alongside Milena Mileva. I think it's a really interesting time to be talking to Iain about this, as we are actually coming up to the 5th anniversary of Baillie Gifford and Iain and his team running the trust. Obviously, a lot has happened in that time, and I think we'll cover some of that today. But I was looking at the sort of peer group rankings on our website this morning, and obviously, despite the obvious growth headwinds, this trust is the best performing fund in the UK companies sector over the last year. Which sort of kind of raise the question, is sort of growth now on a path to recovery, or are the sort of benefits of innovation pushing through regardless? And maybe is even the UK an interesting sort of place for growth more generally? So hopefully we'll be able to address some of those today. But before we do that, Iain, can you just perhaps sort of give us a few minutes just to perhaps introduce people who have not heard of sort of BG UK before, or those that need a bit of sort of refresh, please?
Sure. Well, good morning, everyone. I mean, the Baillie Gifford UK Growth Trust is just under 260 million market cap trust. It's our best ideas kind of UK portfolio. Milena and I pick about 45 of our best names, and we try to own them over the long term. And you know, one of the things that we think, and you know, there's a common misconception, and I expect not from an audience that's listening to, you know, James, Andrew, and yourself, Matthew, but you know, that actually the UK, you know, stock market is about the UK economy, and because you can get very depressed when you listen to hear some of the things about the UK economy. But the reality is that in our trust, over 60% of the revenues are actually coming from overseas, and actually some of the domestic revenues are from, I think, fantastic businesses, like companies like Howden Kitchens, you know, the trade kitchen company, you know, and it's got a fantastic long-term growth story there. So I think, you know, the UK is a great place to find growth companies. Now, if you move to the next slide, the way we try and invest, you know, from Baillie Gifford, we're growth investors, we're long-term, and we're very much bottom-up driven. So on the left-hand side there, you can see the pie chart of how the UK market is made up. And it's kind of quite striking that if you're just used to the UK, you just take it as granted. But actually, it's pretty unusual internationally to see a market that concentrated, that the FTSE 100, the largest 100 companies are, you know, almost 85% of the market. But on the right-hand side, you can see the Growth Trust, the fund that we're running, and you can see it looks very different to that. You know, we've got much more in outside the largest FTSE companies. And the reason for that, in our view, is very simple, that we follow the growth. We don't think about, you know, is it a FTSE 250 or 100 companies? Is it a growth company on a long-term basis or not? And what we think is that there's a lot of companies, large companies that are very well-known companies, which we just don't own because we don't think the long-term growth story is that attractive. Now, in the short term, or maybe not in the last year, you're kind of kind to point out the short-term performance, but the medium performance has been a bit tricky because not owning things like the oil majors or some of the big pharma companies has not been helpful to us, as there's been a kind of flight away from growth and more into kind of risk-averse kind of companies. But we still think long-term, you want to back the companies that we think are going to have above average growth rates. So we're not going to change our style. And it's kind of interesting that our portfolio characteristics have not changed. And if you go to the next slide, this really kind of tries to summarize some of the points about our stock picks in the portfolio, that what we're looking for is high growth, high quality, good financials, and kind of low debt. And you can see in the portfolio, and this is numbers from taking a couple of months back, that, you know, we've got higher growth in terms of sales growth, we've got better gross margins than average, good earnings cash flow, and also lower net debt, considerably lower net debt than the market. And we want to hold these stocks for a long time. And you can see there that, you know, we've held over 70% of the portfolio for more than 5 years. Now, that can sound occasionally a bit boring, because when Matthew will ask you, what are you up to? And you can say, well, not very much. It's not really kind of exciting. But actually, we think to benefit our client, our shareholders in the long run, our fellow shareholders, Milena and I really believe that you want to pick good companies and try to own them for as long as you can, and not kind of get disheartened, when growth's out of style and the share price doesn't do particularly well. But when fundamentally the business is still doing really well, you want to own it for as long as you can, because in the long run, we think that share prices follow fundamentals. And there's a very good example of that on the next slide, Matthew, where we talk about a company that we've owned in our other portfolios longer than the trust. We've owned it from the trust since from the go. But this is a company, Ashted, the plant hire business. We bought it back in 2010, and we've owned it ever since. And you can see there's been ups and downs, but actually the fundamentals of that plant hire business have been getting stronger, and it's been a great investment. And I'm not saying that every stock in our portfolio could be as strong as this one, but it's a principle of let the fundamentals do the talking for you, rather than me trying to predict what the stock market's going to do over the next 6-12 months, because I have no idea. But what Melina and I have spent a lot of time thinking about is, do we think a business like Ashted or other companies like Offshore Trader or things like that, do we think they have that growth potential over the next 5 years? And if we do, we want to own it, because the longer you own it for that period, the better chance you are to actually capitalize on that share price outperformance. So we just kind of be patient. That's the key thing for us there.
Yeah.
In terms of the portfolio more broadly, and it's going back to this point, Matthew, but whether there are growth opportunities in the UK, and I thought Andrew's kind of comments about the FANG stocks is kind of interesting, because that's always the thing that people worry about in the UK, is that it's all dull. There's nothing really exciting or to invest in. But what we're trying to show here are kind of themes that which are in our portfolio. Now, just to be clear here, we pick stocks and then we kind of said, well, what are the themes, rather than saying, here's a theme, let's buy some stocks to fill the bubble. But what you can see here, that there are lots of interesting areas in the UK, from R&D innovators and data companies like Experian, companies that are kind of exploiting the digital enterprise and so on, or market share gainers. And that's a really important point, because that's another way to get growth. So the point I would say is, if you're willing to be a bottom-up stock picker, there are interesting opportunities in the UK. And I don't know if we want time, Matt, to want to talk about stocks, but I've got 2 or 3 examples on the next couple of slides. So maybe if you want me to talk about them, or happy to take questions, really, just to kind of really bring it to life.
Well, I think we've got a sort of few questions coming in, but I think certainly some stock examples would help bring this to life, whatever you like. Sure. I'm just interested in the process, because you look at something like Ashted, you think of that as, plant hire, sort of what are the barriers to entry. It doesn't feel like a growth business, but sort of clearly it is from your slides. So perhaps we talk through some of these examples. That'd be really helpful. Yeah,
well, I mean, on Ashted itself, the reason why we think it's a growth business, because particularly in America, that's where the bulk of the business is. Historically, people owned assets, construction companies. Unlike the UK, where the penetration rate of hire is much higher than in the UK than in the US, but that is changing. And I think it really started to happen, accelerate after the great financial crisis, when companies couldn't actually get the finance to buy things. They had to hire it. And then they actually realized, this is a lot more convenient to me than actually kind of tying up a lot of capital and spending a lot of cash to buy things. So actually the rental penetration has been going up. So that's what, in the short answer, Matthew, why Ashted we think has done really well, is because there's a growth, there's an underlying market share in the sense of rental has been going up quite significantly. Now, the way we think about growth more broadly, and there's 3 stocks I can briefly talk about, Matthew. And it's really trying to encapsulate what types of growth are we looking for. And I would say we're very growth agnostic. But there's one type of growth, which is kind of steady growth. And Softcat is a business that we bought in the last financial year, which I think is really interesting. And what it does, it provides IT solutions and services to businesses and the public sector. In plain English, for example, Baillie Gifford, for example, is a customer of Softcat. If I need a new laptop, my IT team gets Softcat to get it from Dell. They get the basic stuff set up. So when I come down to pick up my new laptop, it's a pretty pain-free and hassle-free kind of experience for me. Now, audience people might say, well, God, that's not exactly rocket science, is it? But you would be surprised. And when we spoke to our company, we'd actually replaced our previous company with Softcat. And the account kind of person that was dealing with them said, look, I know it sounds really simple, but when we ask for stuff, they deliver it on time and in the exact configuration that we ask them for. And that doesn't happen a lot. And it didn't happen with our previous company. And it's a big pain in the ass because people like me turn up and it's not the thing I'm looking for. And I get kind of, because I'm a fund manager, I have a hissy fit and things like that. And you know, and then I storm off and I come back in a couple of days' time. Obviously, hopefully I don't do that. But you know, it's a bit of a waste of time. Whereas, you know, companies like that are doing simple things, but it's not easy. And people like that. And then when companies say, look, actually, I need to work on my digital, I need to kind of upgrade there, but I don't quite know how to do that. People like Softcat are a great, they can help you, they can give you the kit, they can give you advice and service and to do that. And this is a quietly growing business because companies are always perennially having to upgrade their IT. They're just, you know, whether people need a new iPad or a new kind of laptop or whatever, but also the fact that things like digital, that companies are having to spend more money on these areas, and they want people that they trust to do it and to do it with them. So that's kind of Softcat. So it's a very there's a problem there. They have a good solution, and the customers love them. So that's the first one. The next slide kind of talks about a very different type of growth, and that's probably one that a lot of people understand. Baillie Gifford is kind of, you know, well known for, which is disruptive growth. But there are UK companies that are disruptive growth businesses, and this is Wise, which or TransferWise. You may have heard of that, and I don't know, Matthew, if you use it. But the question is, you know, if you're going abroad or if you're going to make a bigger purchase abroad, if you go to your banks, you don't get the best rate.
No.
And what Wise have done is basically create a system and a kind of network where basically you will save money pretty much every time you go abroad using the, you know, and you want to get foreign currency or you want to make a purchase. If you use the Wise platform, and this is no plug, I use it, but you know, I think it's you win, I win, because basically Wise gets bigger, sort of thing. And it's interesting because they are getting bigger, but they're still a small part of the market. Now, the banks dominate it. The banks never want you to know how much they make from this, because if you look at a bank kind of P&L or a presentation, they'll never talk about it. But that's usually a good reason why they don't, because they make so much money from it. And what was really interesting, Matthew, was last year we had one of the big banks in, one of the finance director. I mean, we ended up on talking about Wise or foreign exchange, and I'm not going to mention who it was. I don't want to embarrass them. Basically, they were saying, "Well, yeah, well, look, we've got a much bigger kind of pool of that, and you know, if we wanted to, we could squash them, and you know, we could do it." And then we said, well, you know, when we asked what I call the daft laddie question, which up in Scotland is kind of quite a common thing, which is this, you know, sort of like, well, and I said, well, why don't you do it? And the guy was just kind of like stunned and nonplussed, and he kind of started muttering, well, actually, well, you know, our systems and blah blah blah. And the truth is that it's true that the banks do have a big market share, but as we all know, the banks have their IT systems are an absolute disaster here. They don't speak to each other. There are lots of legacy systems, and even if they wanted to do it, they'd have to get so much internal you know, buy-in to actually do it. And to me, it's almost a bit like, you know, these kind of, you know, entrepreneurs, you know, people trying to teach entrepreneurship, and it's some guy that's from the public sector who's never actually done it in his life, but it's kind of talking about it. It doesn't feel authentic, it doesn't feel real. No. Whereas Wise are genuinely, you know, entrepreneurs, and they can do it. So that's a really interesting kind of, you know, disruptive growth business. And then the last one, Matthew, is it's kind of what we call blue sky, and it's our only unlisted investment in the trust. It's a very small investment, less, you know, it's less than 0.5% of the fund. It's a company called Wayve. If you can move on to that slide if you can, and what that does. I think we're still on Wise. I don't know if you can move on to the next slide. Here we go. Yeah, perfect. Thanks. And what it does is has a different approach to autonomous driving. Now, you've probably heard of lots of American companies doing autonomous driving solutions. You know, you can see people doing it in California and so on, but they've not cracked it yet. And it's interesting because the reason why the way they've generally tried to do it, this is a very simplistic way, but you know, bear with me. But what they've tried to do essentially is create rules. So it's almost a sense of, you know, the car is driving along, a van comes out from the left-hand side, you know, you should brake type thing. That's the kind of, or, you know, somebody steps out in front of it, you know, you brake. But the problem is, as you can start to think of, when you start thinking about it, there's so many solutions and so many different things that could happen, that the rules then become incredibly complicated. And do they always, you know, capture every possibility that's coming? Probably not. Now, what Wayve have done is look at it in a different way, and what they do is almost kind of it's almost using AI. And I know it's kind of it's a thing of the moment. I'm sure everyone's talked about it, but they were doing this a while back, saying like, why can't we use AI, deep learning, to train the system to kind of get better? So it learns itself rather than you have to feed it in rules, because it isn't that a way that it'll learn much more quickly. And the way they do that is they collect data. So they have a tie-up with Ocado and a couple of other kind of companies where they have on Ocado, they have the kind of a camera, and they collect the data and they feed that data into the network, and the network kind of processes that and learns on it and goes, well, that's what the driver did. I understand, things like that. And the system kind of gets better. And it's very interesting that viewers might be interested. If you go to Bill Gates' blog, you know, the founder of Microsoft, he actually was driven in a Wayve car not that long ago, and he talks about it. It's a really good summary of what actually this is all about. You also have the memorable image of Bill Gates stopping and going and get fish and chips in London, and wolfing down with fish and chips, which I never thought I'd ever see in my life, but and he enjoyed it. So, you know, that's Bill Gates. You know, he likes autonomous vehicles like Wayve. He also likes fish and chips. But yeah, you learn something every day, as they say. But
absolutely.
So anyways, that's kind of a few examples of things that we look at. So we're very style agnostic in terms of growth, as long as it's growth, whether it's steady growth, disruptive growth, or potentially blue sky growth. And you can get all of them in the UK. That's the kind of the bottom line. So end of message, you know, it's a sunny day outside. You know, we're still remaining very kind of upbeat about the prospects in the UK. You know, it is a good hunting ground for investors. It's still, you know, we're starting to see people look at the fundamentals again. There was a bit of a kind of, with rates going up, people were just not interested in growth. I think that might start changing. I don't know. But what I am confident about is that we have a portfolio of stocks which have faster growth potential than the market, and we think we will get rewarded for that at some point.
Excellent.